Hello everybody, this video is entitled Will Macro Madness Ever End? This is a macro video, this is a video for the super fans of the channel, perhaps a video for people who were there with me in the early days when the channel, of course, titled Beat the Denominator. The whole point of Beat the Denominator is the idea that we gotta beat the insane dollar monetary printing that is coming. But unfortunately, over the past 5 years, because of macro fears, macro jitters, mostly related to unemployment, inflation, and how they relate to interest rates, and I would argue mostly because of a very, very stubborn chair at the Fed, extremely stubborn, we have had a market who's been held hostage by macro discussions. And this continues today. We are still today hostage by macro discussion. Okay, so this morning we have unemployment coming back high, right? That's supposed to be good to drop the rates. If unemployment's high, you gotta drop the rates to foster new jobs, to create new jobs. And we, unfortunately, also had the barrel of oil, $90 oil. And so that's bad for inflation because people are saying, well, inflation's gonna go up because oil is going up. And so that's against, that bodes poorly for a drop in interest rate. And so the interest rate of the United States is, and any central bank really, is in a catch-22 situation. You have unemployment going up, and then you have inflation perhaps maybe going up. And unfortunately, so many of our stocks have been impacted by the denominator, including NVIDIA in there. I consider NVIDIA heavily undervalued. NVIDIA, for example, has stopped its run. It's not really running anymore. It should have run, especially after that Q4 earnings. NVIDIA should have totally run. It didn't. And then if you look at any risk asset, I'm kind of using HIMSS performance is a bit idiosyncratic, but I'm using HIMSS as a proxy for like high growth stocks. So many high growth stocks are down between 50 and 80% for the past 6 months. And you look at Bitcoin, of course, down nearly 50%. Even Tesla is down, while Tesla is literally going through the explosion of its business model. What the Tesla investors have been waiting for like 5 or 6 years is finally happening, and the stock is down. Why is everything down or not up as much as it should be? Well, it's all because of that stubborn Fed, and it is because of the doom and gloom thought that really is pervasive in the market right now, which is, for some reason, a lot of people have convinced themselves that the rates are going to stay this high. That's the problem. And there's a lot of doom and gloom out there. So this is a macro discussion trying to answer the question, are rates going to stay this high? And of course, this channel is named Beat the Denominator. If you know me, you know I think rates are going back to zero. I think we have no choice. Rates are going back to zero. That's the long-held view of this channel. That view, as underlied all of my investing, is determined by that view. I think there is absolutely zero desire for a Great Depression on steroids. Zero desire. If you look at the Great Depression, it happened when the rates were high. The Fed was very stubborn back then. But the people back then in the 30s, they were tough. They weren't used to all of the easy life that we have today. I think many scholars would agree that the Great Depression could have been avoided if they had dropped the rates in the 30s, but they didn't do that, and they decided to go that path in the 30s. I don't think they are going to decide to go for catastrophic collapse in the 26, 27, 28. A lot of people think there is going to be a catastrophic collapse coming because they are going to keep the rates high. And you know what? If Powell had just been nominated last year, maybe I would believe that too. But the truth is, Powell is gone in May. That's the truth. And Trump would not have nominated somebody to the post who was not a dove. wash is going to be a dove. That is my view on this. But of course, this view doesn't get the clicks. So I want to briefly address. I started listening Luke Groman, this interview, economic system failure. I ended up being depressed after listening to this episode. And Jack Mallers, I'm trying to not. I listen to this podcast sometimes. I'm trying to not listen to it as much because it's such a bleak view of what's going on. And sometimes I wonder, does this bleak view of what's going on, is this impacted maybe by your lived experience, right? Luke Groman always talks about Cleveland, and then Jack Mallers always talks about Chicago, right? Cleveland and Chicago, right? Perhaps a slightly different experience than what you may see in I guess Silicon Valley, I guess many parts of Texas, I guess many parts of Florida, I guess the South as a whole is doing much better. Maybe the lived experience is kind of a reason of the doom and gloom, right? These old industrial towns have had some trouble with the disruption of the blue-collar worker. So maybe that's the reason. But me, I'm definitely squarely in the tech team, in the Elon Musk team, right? The Peter McCormack show with Luke Groman, they kind of laughed at Elon Musk, saying he was kind of like too optimistic, etc. Anyways, I'm more on the Musk team. I'm more of I'm on the Larry Lepard team. I think they will print like nuts. I think the West is going to, and it's to the point that Japan is even somehow following, somehow as if there was any wisdom at the Fed right now, right? Somehow Japan is believing that they need to raise their rates too. But to me, Japan showed us the way, and Europe was well on its way to showing us the way. And the way is simple. There is no desire from the population, and the population votes. They have zero desire to have a 1930s style depression on steroid to save the currency. The days where people want to save the currency, in my view, they're entirely gone. And in fact, most people don't know these intricacies of the currency. So their argument of the doom and gloom view is this. Because of AI, robotics, deflation, right, that's going to lead to a major collapse in jobs and a major collapse in companies' business. Companies are gonna lose their revenue streams. The government's going to lose these receipts, and because of this major collapse of the tax revenue, collapse of the income for companies that have a bunch of debt, right? Collapse of revenue of companies that have a lot of debt. Collapse of, say, banks and real estate because people are going to lose their jobs because of AI and therefore they can't pay the mortgage. So the whole idea is that you're going to have a whole collapse in the economy because, say, all you need is like 10% of people to be impacted by AI for it to trigger a domino effect where everything drops. And then, of course, the government eventually can't pay the national debt. They can't handle it because the receipts drop, the tax receipts drop, people can't pay their mortgage, etc., etc., etc. And of course, this doom and gloom view exists only if you think that the rates are going to stay at 5-6% if you include the bank's margin, if you include the risk premium, right? People think the rates are going to stay at 5 to 6%. That's the only scenario where this happens. Now, I know a new Fed chair is coming. And there is a solution to this problem. It's a very easy solution. Take the rates back to zero. That is obviously the solution to all of this. If you want to avoid a catastrophic collapse, domino effect, based on AI just being 20% effective at reducing jobs, which it probably will reduce some jobs, reduce some receipts. If you want to deal with the issue of deflation created by AI, there is a solution to this. Bring the rates back to zero. That's the solution. Japan showed us the way. The EU showed us the way. If you drop the rates to zero, you are essentially turning debts that are repaid that are to be repaid, and historically, of course, when commercial banks issue debt, the money is created. When people pay back the debt, the money is destroyed. What do you do when you drop the rates? That money becomes essentially permanent. It becomes essentially permanent, and you do that printed money. You make it essentially permanent by dialing back the rates to zero. Just dial back the rates down to zero. And this is, of course, the path we were on prior to the events of 2020, which kickstart a awful decade for just about anything, right? And all, at least macro-wise and market-wise, awful decade. And so before we had this great bluff, which in my view was triggered by Powell, before we had this great bluff, it's important to note that, for example, in March 2020, the rates, and they went a little lower after that too, the rates, for example, for home loans in Europe were 1.39%. I remember these days vividly. I still have friends and family in France. I remember many of them getting their hands on 25-year mortgages, paying like 1.75%, 1.5%. Let me tell you a thing. If you have a 1.5% mortgage, you are in no hurry to pay it off. You are in no hurry to pay it off. No hurry whatsoever. In the USA too, the rates were 2.3%. I know people in the US who still have a 2.3% mortgage, right? You're in no hurry. This literally solves the problem. So rates right now in the US for mortgages, for example, they're 6.5%. Well, that's a big problem. Right? If you have a 6.5% mortgage and you just lost your job, that's a big problem. Here's something you can do. Here's something you can imagine. Let's drop the rates back to 1. And if you drop the rates back to 1, all of a sudden your big problem is not that big of a problem. And the same is true for companies. Companies are hurting a lot right now because the interest rates are so high and they gotta roll over the debt at 7%, 8%. And yeah, you know what? If you contracted debt in 2020, in 2019, you contracted debt for like 2%, 2.5%, and now it's coming due, and you have to like roll it forward at 8%. Yeah, from 2% to 8% means you're fine to you're bankrupt. That's what it means. But what if you roll it forward at 2% again? You're still fine. You're still fine. Same for the government. If the government starts rolling forward all of its debt at a rate of near zero, they can hold that debt for a very, very, very long time. Dropping the rates back to zero is the solution to the doom and gloom. It is the solution to the doom and gloom. And the currency, people talk about saving the currency. The currency is going to go to zero regardless. The currency is going to go to zero regardless. Because, let me show you this. This is the most important chart. Of course, I think they will choose to print. With unemployment going up, I think they will choose to print. With government debt piling up, I think they will choose to print, especially if we add war costs. People saying the US already spent something like $50 billion already in the past 6 days with the Middle East tension. But most importantly, I want to call to logic. We've had 5 years of pain, essentially since 2022, late 21. We've had 5 years of pain. Whether it's the job market, whether it's the real estate market, whether it's, I suppose, inflation, whether whatever. Like we've had 5 years of pain. And that's because of the rates going for like a 20-fold increase in next to no time back in 2022. Did that pain help us in any way with the money supply? Did it? This is Fred. This is the Ebb2 money supply. We barely made a dent in the trajectory. We barely made a dent. I mean, smoothen that long-term curve. You can see the inflection is there. We barely made a dent in all of the money that was printed between 2020 and 2022. So why did we go through 5 years of pain for if at the end of the day, the pace of the monetary printing is essentially the same as it was before 2020. If you look, it's essentially the same pace of monetary printing, and the 30 to 40% big spike in money supply that we had in 2020, we haven't reduced it at all. The inflation that we got was cemented in. That inflation is now permanent. The average house now is like 380. The average house was 200 and change, and it's permanent. That increase in the price of the average house is permanent. Why did we go through 5 years of pain for, if we are not actually succeeding at reducing the money supply by having rates this high? Anyways, I think money printing is going to go insane in the next few years because they are going to drop the rates back to zero. Also, please note that Fred's M2 is only within the US financial system. There are foreign dollar banking networks, right? The euro-dollar system, foreign held dollars. And this, we have no idea. We have no idea how much monetary printing there is on this level. Absolutely no idea how much monetary printing there is. And the odds are foreign held dollars, euro dollars printed like crazy. That's the odds in my view. And of course, these dollars printed abroad make their way back to the US through trade and travel and all that sort of stuff. So anyways, we have two choices. The Fed chair has two choices, and I think Trump nominated a dove, and I think they're going to make the choice of dropping the rates. That's what I think. But you have two choices. You could decide that so many companies in the S&P 500 are going to die. You could decide that so many states are going to collapse. You could decide that so many cities are going to die. Pensions are going to be wiped out. Households, so many of them are going to die. So you could decide all of that by keeping the rates high. And over the course of 100 years, the dollar goes to zero. Or you could accept that rates need to drop, and so decide that companies, states, cities, countries, households survive. How do they survive? They survive by making that long-term debt permanent. If you drop the rates from 7% to 0%, you remove all motivation to pay back that debt. You make that debt essentially permanent, because if you have a 1% interest rate on $1 million, who would rush to repay it? Except like the most hardcore Dave Ramsey follower, but who would rush to repay a 1% debt? Your states, your cities, your households, your governments certainly won't. And guess what? If you made that choice, what would be the value of a dollar in 100 years? Oh, it would still be zero. It would still be zero. So at the end of the day, the dollar is going to zero, but there's a choice that you can make where everything collapses, and there's a choice that you can make where you just accept it, and you slowly accept it, and you slowly move to hard assets, right? You slowly move to Bitcoin. You slowly move to crypto. Sure, even gold. Slowly move a little bit to gold. I really don't care. But you simply accept it and slowly move to harder money, while, of course, the fiat currencies go to zero, which, by the way, is the history of the world. The history of the world suggests that fiat always goes to zero. Who cares about what I think, right? Nobody really cares about what I think. The question is, what do the leaders think? Well, let me tell you what the leaders think and what they want to do. They all want to spend more money. They all want to spend more money. All of them. Perhaps on different stuff, but they all want to spend more money. UBI, right? It's heavily debated. Don't we have the biggest city in the US is talking about free grocery stores? People vote. It's a democracy. They're always going to vote for more money. They're always going to vote for more help, more stuff. Popular policies include things like checks, things like helicopter money. You may say UBI, for example, is more of a Democrat view, and it's more of a tech-held idea, and so are free grocery stores. But helicopter money, right? Sending checks to American. It's definitely very much a Republican idea, definitely been floated to send a tariff check to the American people before the midterms. You remember that, the $2,000 tariff check from 2 months ago. So they want to spend money. They want to give money to the people. It really doesn't matter if it's left or right. And of course, you need rates to be to zero to do that. I was surprised by this, but war actually seems to be very good for public opinion. If you look at the polls of Real Clear Politics about the conflict in the Middle East, if that poll is to be believed, apparently it's popular. I don't know. But I know it's good for money printing. Because war costs a fortune. Apparently, we spent 50 billion in like 5 days or 6 days. So it's good for money printing because war costs a fortune. And this is the last point. And they've done these studies. As you know, inflation moved back a tad under 3%. From, a high of 8% or 9%. You look at the polls, you look at people's opinion, they will always tell you inflation is high. Even when inflation is low, people will always tell you inflation is high. Just like people will always tell you salaries are low and pay is low, and they will always tell you inflation is high. And so if you rely on inflation by polling people's sentiment, people will always complain about prices, even if it's low. They will always do that. If you look at the history of how the gold standard was lost, go study either the Lynn Alden books or Saifedean's book. If you look at the UK, was it right after World War I? I think it was in the 1920s or 1918 in the UK, right? They were talking about reducing the salary back to what they were before, right? And unions fought it. People disagreed. Even though we could have gone back to a gold standard, people never agreed to revert back to the lower salary, even though there was no point to have higher salaries anymore. So people will always want higher salaries. People will always say inflation is high. And therefore, I say let it be. And I think we're not going to have a choice. I think rates are heading back to zero. So anyways, kind of hot take, I suppose, depending on where you stand on that idea. But, as always, this was not investment advice. This is not financial advice. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.